Howdy, Jacob here. Today we're looking at ticker symbol ITRN in the communications equipment industry. Looks like they provide location-based telematics services and machine-to-machine telematics products. Okay, headquartered in Israel, incorporated in 1994. Growth is not extraordinarily substantial, but we are looking at mid to high single digits over the last 10 years, so fairly impressive. But we do see a decline in gross and operating margin, which is a negative. And then the return on invested capital has also been going down a little bit, but is starting to get back pretty close to what it was 10 years ago. Okay, let's look at the balance sheet. We see that there's about 53 million cash on hand with 0 million in short-term debt, 0 million long-term debt. All right, so balance sheet perspective, we're looking at a very safe investment. Cash from operations shows essentially the same capital expenditures this year versus 10 years ago, with fairly substantial growth in cash from operations. So we are seeing a good production and increase of free cash flow. They have been using that money to get rid of some debt, pay a dividend that is currently 3.7%. So that's a pretty healthy dividend. And that dividend payout of $12 million on their 5-year average free cash flow is probably about 25-30%. So really still a very small payout, which is good for them. Obviously, every use of cash is something that they could do different. So if their company's shares were extraordinarily cheap, it might make the most sense to reinvest through buying back their own shares. If there was an acquisition that made sense to make their company more efficient, or reinvestment opportunities at historical, at least 20% plus rate of return, that would be advantageous. But if they have no other opportunities, paying down debt, paying a dividend is fine. But I feel like I'm a little hesitant in the fact of the last 5 years. That's literally all they've done. They haven't made acquisitions or reinvestments or repurchase shares. And I feel like there's no way in the last 5 years there wasn't a great opportunity to do any one of those three things, and to just pay down debt and pay a dividend. And so I do feel like innately, initially, I'm saying pretty poor allocation from the board here and from management, but is what is. There's a possibility that shares weren't stupidly cheap, but they had no opportunity to acquire and reinvest. But I highly doubt that. And so we are seeing that the decline in margin is also there, which is a bit saddening and a bit of a negative. But if we start making some assumptions on the revenue growth side, I'm probably going to stick with that mid to upper single digits, maybe 7%. Looks like they have been, doing a good job of increasing those revenues, and then they've just been buying down debt and paying a dividend. So I don't think there's really an excess premium on P, price to free cash flow. I think with margins declining, maybe let's do 12 and 14%. I think I feel comfortable with that. I mean, it was pretty low from COVID, or around the COVID era, it dropped pretty quick, but I'm still think I'm fine with that. And then share repurchases, I don't really see share repurchases here, but it looks like their shares have actually gone down a little bit. I'm going to assume keep that flat, saying that maybe they reinvest back in themselves, but the overview, their dividends is all over the place. I'm probably comfortable keeping that the same, but we get to a price that's pretty close to a buy right now. I wonder what their historical price to earnings and price to free cash flow are. So let's look at that. So historically, their PE is pretty low, probably averaging around the 12 range, it looks like. So for how much growth this company has had, it's very odd. Yeah, it has been as high as 22 and stuff, but that was also, the market was possibly a bit frothy, but as low as 5. I would probably say we're actually averaging about a 12 here. So I try to do that more so when I do a deeper dive on the company, but I also don't want to I want the company to be a screaming deal before doing my own analysis. And so all I did there is I looked and said, you know what, the revenue growth that I would have done, or the PE price free cash flow with the 7% revenue and these type of figures, I think a 17p in price free cash flow makes sense. But looking at history, it's the same. You want to balance out, um, what you think it's worth with history. It's the same when you're buying a house. You can't just do one versus the other. If you're if the geographical region is $250 a square foot and yours is $200 a square foot, you would say initially, oh, that looks very cheap because the average is 250. But then if you look in that particular neighborhood, that particular area, there's a possibility that it's maybe not as nice of an area, or um, just all the different factors that could go into that. Investing is the same thing, where you can't just generalize all industries and sectors under the same broad P and price free cash flow. This is where the art kind of comes into effect, and you kind of have to balance out historical P price free cash flow with where was their revenue growth then, what was the outlook there, and I think we're having a similar outlook now to what it's been the last 10 years. So I think going pretty much with average on the terminal values seem to make sense to me. So we do see that it's still pretty close. So hopefully not too much longer until I do a deeper dive here. But 27% off really is not that far off. So probably not too much longer until do a deeper dive here. But hopefully you enjoy the video and have a great rest of your day.